Okay, picture this. You're trying to understand how a really complex machine works. Now, you wouldn't just look at it from far away, right? And you definitely wouldn't just stare at a single bolt up close either. You need both. You need a microscope for the immediate gritty details and a telescope to see the big picture. Well, in this explainer, we're going to build exactly that, a dual-lens toolkit for analyzing stocks. We've got the technical microscope for immediate price action and the fundamental telescope to evaluate a company's long-term mathematical health. Let's get into it. Okay, let's dive into this. Here is our roadmap for today. First, the technical lens, looking at market structure. Second, the fundamental lens, focusing on financial ratios. And third, indicators for long-term investors. So to really wrap our heads around how these two disciplines work together, think about buying a car. Technical analysis? Well, that's like looking at your dashboard. It tells you exactly what your current speed and momentum are right in this exact moment. Fundamental analysis, on the other hand, is literally popping the hood. You're getting in there, checking the engine, checking the oil, figuring out if this car is actually built to survive a long cross-country road trip. To drive successfully, you absolutely need both.
All right, part one, the technical lens market structure.
Now this right here is the absolute foundation of reading a price chart. As you probably know, markets don't just move in straight, predictable lines, do they? No, they move in waves. And what we are looking for here are market structure shifts, or MSS. Look closely at the peaks and valleys. You'll see HH for higher highs and LL for lower lows. Identifying these little shifts? That is step number one in figuring out who is actually in control of the immediate price action. Let's break down the actual rhythm of these trends. In an uptrend, the highs are broken before the price reverses to take out the low. It's kind of like walking up a staircase, right? Step by step, moving upward. But in a downtrend, it's the exact opposite. The swing low is taken out before any reversal can happen to take out the swing high. Basically, the floor falls out before you ever reach the ceiling.
So the crucial point is, and you really want to keep this in mind, how we define a break of structure, or BOS. Listen, it is not a true break if the price pushes above the swing point with just a wick. It absolutely must be the solid body of the candle. Think of it this way. A wick just means the price kind of poked its head through the door and immediately backed out. But a candle body closing past that level, that means the price walked in, sat down, and unpacked its bags. It's a huge difference.
And one of the absolute best, most direct ways to spot that break of structure is by watching for very specific candlestick formations. Engulfing candles. That's where one candle's body just completely swallows the previous one, and pin bars. These are incredibly high probability signals. They're basically flashing neon signs telling us, hey, the market has definitively moved past the old support or resistance.
Okay, shifting gears now. Part two, the fundamental lens, financial ratios.
So, grabbing our telescope, when you start digging into fundamentals, man, it is so easy to just get totally lost in an endless sea of spreadsheets. But don't worry, we've got you. Here are 5 absolute must-know ratios to cut right through all that noise. And what makes this list a real game changer are the thumb rules attached to each one. These rules basically take super intimidating, abstract high finance and boil it down into rapid-fire, highly practical wisdom that you can use right now when you're screening stocks.
First up, let's highlight a massively important metric for profitability: return on equity, or ROE. The rule of thumb here is absolutely crystal clear. You want to look for a company with an ROE greater than 20 for at least the last 3 years. No exceptions. Since ROE is just net income divided by shareholder equity, consistently hitting this greater than 20 benchmark proves beyond a doubt that the company is highly, highly efficient at taking your invested money and turning it into actual hard profit.
Next on the list is the current ratio, which is all about evaluating liquidity. And the rule here? Simply stick to a ratio greater than 1. That's it. It's just current assets divided by current liabilities. Seeing a number above 1 means the company actually has enough short-term assets on hand to cover its short-term debts. Basically, it means they aren't going to go completely belly up if their creditors come knocking tomorrow morning. Now, a quick word of caution, because context is literally everything here. The rule of thumb says a debt-to-equity ratio over 1 is generally pretty risky. But actually, let's add some nuance to that. Acceptable debt levels vary wildly depending on the sector. For example, a heavy, capital-intensive utility company, it's naturally going to carry a lot more debt than, say, a lean little software startup. So the big takeaway here is to always compare a company against its direct peers.
Moving right along to Part 3, Indicators for Long-Term Investors.
If you're the kind of investor planning to buy and hold for years, maybe even decades, these are your top 5 indicators: PE ratio, earnings growth, earnings visibility, free cash flow, and of course, return on equity. Now, what's really interesting about this is that these metrics force us to stop staring at the present moment and instead project the company's financial health deep, deep into the future.
Let's look at the PE, or price-to-earnings ratio, for a second. Now, while a low PE is generally what you want, it's not some perfect magic measure of value. In fact, it can actually be a massive trap if a company is highly cyclical. Businesses where profits just totally boom and bust along with the broader economy. So the golden rule? A massive PE ratio is really only justified if there is massive, sustained growth to back it up. The PE and growth numbers absolutely have to match. When you're out there hunting for really strong earnings growth, you've got to focus on sectors that are fundamentally positioned for massive expansion. Based on our source material, we're looking at industries like organized retail, renewable energy, diagnostics, and tourism. And these aren't just picked out of the hat, right? They are backed by massive, long-term societal trends that create huge market tailwinds for these companies.
But hey, growth isn't the whole shebang. You also need predictability, and that is where earnings visibility comes in. This is all about finding businesses that are way less likely to experience sudden, terrifying drops in their earnings. For this, you look to the stable, everyday sectors: FMCG, pharma, banking, and standard consumer goods. Simply put, people are always going to buy toothpaste and medicine, right? It literally doesn't matter what the broader economy is doing.
And finally, we have free cash flow. Honestly, this is arguably the ultimate measure of true financial strength. It's the cash left over after all operating expenses and capital expenditures are paid. I want you to think about its power sequentially. Step 1, a strong free cash flow lets a company reliably repay its debt. Step 2, it allows them to invest in new growth without having to borrow a dime. And Step 3, it rewards you, the shareholder, with dividends. It is quite literally the lifeblood of a solid long-term investment. So, we've peered through the microscope at technical chart structures, and we've gazed through the telescope at fundamental financial ratios. And as you've seen, both of these lenses are absolutely essential. But as we wrap up this explainer, and you go to refine your own personal strategy, I want to leave you with this question. Based on the tools we've just unpacked today, are you inherently more comfortable reading the chart's immediate story or calculating the company's long-term math? Something to think about.